Hello again, my name is Nico. Welcome back to our series on personal finance and asset management. Today, we're going to take a closer look at the lump sum investment strata of the asset management table. So real quick, a review. What we're looking at here with asset management, we've got my building here. Insurance is our foundation, protecting us against a catastrophic loss. We want cash on hand to help cover any expenses for the next 3 to 6 months, just in case, we lose a job or there's a pandemic or something. Then we want a savings plan, and a savings plan we want because of what Peter told us last week, that it is mitigated over time, a long time, diversified across different funds in a portfolio of mutual funds, spread across industries, and we use dollar cost averaging to be buying shares of those funds on a monthly basis over a 10, 20, 30-year time period, right? Now, a lump sum is a lot different. That's what we're going to take a look at today. We're taking a look at the lump sum form of investment. And this usually requires a lot more money than a savings plan. A savings plan can just be, $200, $500 a month. Peter was saying as low as $40 a month, right? And also the risk is a bit higher than the savings plan. So if we also remember that the way this works is that risk goes up as we go up this structure, right? And the risk is mitigated. The risk of the higher risk situations here, these higher risk investments, the risk is mitigated by the lower risk holdings, okay? So a lump sum investment, for me, is a lot like a very long-term trade, right? We put in a position, we buy shares, and we hold it. Now, another way that we can mitigate the risk on these is by making a portfolio of lump sum investments. So if I have, 3 or 4 lump sum investments, even more, maybe I've got 10 or 6, right? I've got a number of these. If one isn't producing very well, if it's not doing very well, hopefully the others are. Now, I personally am not a big fan of the lump sum investment. For me, like I said, it's like a really long-term trade. And let's take a look at one in particular that that somebody close to me has. So, for example, this person very close to me is invested in this CNP Unicredit Vita F Strategia Stars. Right, this is offered to us by a bank, okay? And one of the features of this is that it needed to forget this. The line is fine. There's a 5-year period that you have to keep your money in the account with, or you have penalties for early withdrawal, right? Not certain why. Okay. So if we go back here, we can see exactly what the situation was. The advantage is that there's money put away. The disadvantage is that, without regular contributions, we don't take advantage of any of these dips and valleys, these peaks and lows in the trade, in the fund, right? So it happened that 5 years ago, this fund was bought into at, it's high for the 5 years practically. it went down almost immediately, and it came back up, and it came back up, and okay, for a moment it was higher, but this was before the 5-year period, contract period was over, so you couldn't get out at this point. And during that time, it came down, and it looked like it was coming out really well until COVID happened. Oh my gosh. And then it's coming back up again. Well, this particular fund is a mirror fund of the Italian market. Okay, so as the Italian market recovers, the fund will recover. But we've got a ways to go. We've got another 16 cents before it's going to be even at break even, right? And that's not taking fees into consideration. So lump sums are where we take extra cash that we're not contributing to a savings plan, and we use them to help build a portfolio of single payment, single investment, one-time investments, looking for gain over time. Okay, so that's what those are about. They have risk, higher risk than a savings plan, but they're still not as risky as other investments. And we'll take a look at real estate in our next video on personal asset management. Thanks. See you next time.